Welcome to another video in our series on assisting homeowners in their struggles during this mortgage crisis. I'm your host, Tom Cox, and an attorney with the law firm of Cox & Sanchez. In our last video, we discussed the 5 general options available to homeowners in dealing with loss mitigation departments of the various mortgage companies. The options, as you may recall, and we discussed, include as follows: short sale, mortgage modification, deed in lieu of foreclosure, foreclosure defense, and bankruptcy. So let's get started and talk about your options and what each option will accomplish. In dealing with foreclosures, please remember that in most cases, to maximize your results, you will be utilizing a combination of options that best fits your needs. Your first option is a short sale. A short sale is simply a standard real estate sales and closing transaction, but in this case, the value of the property has dropped below what is owed on the promissory note. The note is the instrument that collateralizes the real estate, and the lender must agree to allow the sale of the property to go through for less than or short of what is currently owed on the note. Essentially, you will need to find a buyer for your property at what is now deemed the new fair market price, and the offer is subject to third-party or bank approval. In my experience, I find that most banks are more than willing to enter into a short sale contract compared to other options because the homeowner is essentially doing the majority of the work. The mortgage company still gets the same amount or more for the value of the property than they would if they had taken the property back over foreclosure and had to sell it themselves. And typically, a short sale takes 90 to 120 days from start to finish because of the length of the time that it takes for the mortgage company to evaluate the sales options and to agree to the terms of the short sale. So, here's a breakdown of how a short sale transaction typically works. There are 3 parties usually involved with you in the short sale process, and each will have their own duties and responsibilities to make sure that the sale goes through. You have a realtor, an attorney, and an accountant. I would encourage you to secure the assistance of a realtor who is familiar with short sales, in that with an experienced short sale realtor, they can greatly reduce the time, effort, and stress upon you. Please also recall that a realtor's commissions are not paid directly out of your pocket in a short sale, but come out of the net sums of the sales transactions and are therefore paid by your mortgage company out of the proceeds of your sale. So you might as well get someone who knows what they're doing and can help you through this process. Now, the realtor will need to provide to your mortgage company a list of documents that include, of course, a listing sales contract, a comparable market analysis confirming the valuation of your property based upon current market sales, a contract for the sale of the property, along with an instrument confirming pre-approval of the buyer's ability to close or financing. The sales contract will also have a special addendum, not surprisingly known as a short sale addendum, which makes the contract contingent upon third party or your mortgage company's approval. You, as the homeowner, will also need to provide your mortgage company with a list of documents for their review. This list of documents are standard for all loss mitigation packages. It's the documents that we've previously discussed and are utilized by all lenders, and they typically include the following: 2 years of signed tax returns, 2 months worth of bank statements, a financial statement, typically on the bank's approved financial form, a 4506T, which is an authorization to get tax transcripts from the IRS, a hardship letter outlining the issues of your default, and 2 months worth of income pay stubs or verifications. Some lenders will require additional documentation such as utility bills or profit and loss statements should you be self-employed. As you can see, this process is rather extensive, and therefore most homeowners usually secure the assistance of an attorney who is familiar with this process and coordinates the gathering of all documents from not only you and your realtor, and ensures that the short sale loss mitigation package is appropriately completed and submitted to the mortgage company. Now, once all the documentation has been received from the realtor, including the offer to purchase contract and all the financial information from you, the homeowner, then we will submit the entire package to your mortgage company for their short sale consideration. A dialogue is then established with the mortgage company's short sale representative, who hopefully initiates within a week or two a process which is referred to as securing a BPO or broker's price opinion. Now, this is an appraisal that the mortgage company conducts, which tries to determine that the value of the offer is what the value of the price is. This is the mortgage company's attempt to secure and ensure that it's in the range of the proper property valuations. Once the BPO is secured by the mortgage company, they will then convey their position on value and commence negotiations, and there typically is only one goal to the mortgage company, and that is to maximize the return on their investment. This typically means that they will attempt to increase the buyer's offer, decrease the realtor's commission, decrease the closing agent's commission, negotiator's fee, the attorney's fee, to do anything to squeeze any dollar out of anyone associated with the transaction, including you, the homeowner. If the mortgage company's value is way out of line compared to the offer, and your realtor's comparable market analysis appears correct, you may elect to pay the cost to secure an actual appraisal or secure a special analytical report called a REST report. A REST report, in essence, provides a net present value calculation of the property utilizing proprietary algorithms developed by the U.S. Treasury Department. This report will provide an estimated short sale value of the property and will provide a mathematical computation which clearly demonstrates to the mortgage company that they will make more money, of course remember their sole concern, should the short sale be accepted and the transaction closed instead of proceeding through foreclosure. I will talk more about this invaluable REST report in a later article. Finally, after several weeks of negotiations with your bank, we typically receive from your mortgage company something called an estoppel letter or a conditional closing approval letter, which sets forth the terms and conditions of the sales and the closing transaction. Now, this letter will itemize and approve the buyer. It'll approve the sales price, the real estate commission cost, the allocation of closing cost, and the expenses between the buyer and the seller. It will also contain important information that should be explicitly set forth and evaluated between the homeowner, the attorney, and the accountant, in that the estoppel letter also enumerates how the mortgage company intends to handle and to deal with potential deficiencies. And that's the dreaded issue, is the deficiency. Remember, that is the difference between the net amount that the mortgage company receives from this short sale and the amount that is actually owed on the principal balance of the promissory note, plus all their late charges, interest, cost, other fees and expenses, which you as the homeowner are legally responsible for under the promissory note. We typically see three potential responses to this issue. The mortgage company, bank, or investor will either, number one, they'll agree to waive the deficiency. Of course, in this transaction, it'll close. There's no lingering potential financial responsibility to the homeowner, but there may be tax implications that we'll discuss later in this video. Or number two, the bank can reserve the right to pursue a deficiency at some later date. In Florida, as in most states, there is a certain statute of limitations in which the lender may pursue this action. It's usually 4 to 5 years from the accrual of the cause of action, and the mortgage company can still file a separate lawsuit, much like a credit card or other debt obligation, and sue you for the difference. And finally, the third option that we typically see is where the lender wants to negotiate to seek some type of repayment on the potential deficiency difference. This usually takes the form of a lump sum payment in the amount usually between, say, 10 to 20% of the outstanding principal balance, or they can seek a promissory note, usually in the 20 to 30% of the outstanding principal balance range. Promissory notes are usually at 0% interest, amortized over a 5 to 10 year time period. Please remember that these are merely estimates based upon my experience, and of course each lender is going to be different. So you, therefore, have to make a decision as to what is in your financial best interest. Usually, having a short sale take place is paramount as to mitigating significant loss of what you're usually resulting in pennies on the dollar. And it's beneficial to agree to a short sale even though there may be a promissory note. Please also remember that a promissory note may ultimately be discharged in bankruptcy should you need to utilize that tactic. Finally, you need to be aware that when a financial obligation is resolved for less than full value of the debt, this potentially imposes a tax obligation. It is therefore imperative that you understand the tax implications of your short sale prior to agreeing to complete the short sale. One of the techniques that I like to employ in the short sale arena is that I require an additional clause in the short sale addendum, which Remember, that's attached to your short sale contract. That additional clause allows the contract to also be subject to the seller's approval of the mortgage company's estoppel letter. This means that should the mortgage company approve the short sale contract, but then put in onerous conditions on the approval letter, which will result in significant financial hardship and tax implications to you, the seller, then you may elect not to complete the short sale and may attempt to select another loss mitigation option, as we discussed earlier in the first part of this article. The tax obligation that I referenced is dependent upon the ownership status of the property. In the event the property is being sold short and is the principal residence of the homeowner as defined under the Internal Revenue Service Code Section 121, which is a principal residence which has been owned and used during the 5-year time period ending on the date of the sale or the debt forgiveness as the seller's primary residence for a total of at least 2 years, then, in accordance with the Mortgage Forgiveness and Debt Relief Act and Debt Cancellation Act of 2007, the homeowners generally will be able to exclude from income the discharged debt as long as the debt forgiven occurs prior to December 31, 2012 and is less than $2 million. Should the property be sold short not be your principal residence, then you need to consider the tax implications associated with the sale, in that taxes are generally not dischargeable in bankruptcy. The mortgage company will send you a 1099-C for the amount of the debt forgiven. This sum is not included in the homeowner's income, but reduces the homeowner's basis in the property. This will increase the gain on the sale of the sold property, and that gain is taxable. The amount of the forgiven debt also reduces dollar for dollar the amount of the gain that can be excluded under other provisions. It is therefore imperative that you analyze and discuss these issues with your accountant so that you have a full understanding of the implications of this complicated short sale tax law. As I have tried to set forth in this synopsis on loss mitigation options, short sales are quickly becoming the most prevalent option for both mortgage companies and homeowners. They not only allow the mortgage companies to complete their number one goal by maximizing the return on their investments with the least expenditure of time, money, and effort, from the view that the homeowner is taking on all the tasks of securing and maintaining your property, mowing and cleaning, showing the property, and then trying to get the maximum amount for the property. But you, as the homeowner, are also taking significant and affirmative steps on mitigating your potential financial losses on the property. What ultimately occurs is that because of the diminishment of the value of the property, you can have, say, a $200,000 mortgage on the property, which is now only valued at $100,000. Following the closing, the mortgage company ends up with the property sold to a third party with cash in their hand and now an income-producing asset with a tax write-off for the deficiency difference. And you, as the homeowner, are taking a $200,000 debt and either eliminating it in full or at least partial, resulting in very minimal, if any, promissory note difference, payable over an extended period of time at a minimum monthly payment. You've also been afforded the time to make plans to relocate your family and give a fresh start and try to recover from this mortgage crisis meltdown. Well, I hope you found this information valuable and informative. Please check back with us next week and we'll talk with you about other loss mitigation options, a mortgage modification. We encourage you to provide your questions and comments to our blog or visit us at our website at coxsanchez.com.